I've just recorded an interview with James Kaberry, co-CEO at Titan Wealth. We talk about James's perspective on the wealth management industry and how he's building the company. We're going to talk today about the Titan Wealth business, the plans you've got. You've been on quite an acquisition trail. There's a great growth story behind the business. Yep. But before we get into all that, it'd be great to hear a little bit about your background and how you came to the business.
I started in stockbroking age 16, so I've been in it quite some time. I then moved into financial planning when about age 21. I created a business called Pantheon when I was 30. And luckily built it up over a sort of doing a buy and build and an early consolidator in that space. I sold it in 2007, and from there I actually bought it back again, sold it again, and it has been a sort of bit of a repeat. It's an exciting space. It's the only thing I really know.
Yeah.
And in 2020, we were sat in my garden, and we thought there was an opportunity in the DFM and buy and build space and the consolidation of that. And it was that opportunity that has brought me here.
Well, I mean, what's triggering that opportunity? What do you think the fundamentals in the market are that lend itself to this?
I would say that in actual fact, we are sort of breaking down older models. I think the establishment of existing stockbrokers, wealth managers, DFMs, I think part of the problem has been the disconnect, ironically, between what I would call the old school stockbroking world and the IFA world, and the wealth manager world has now changed radically from where it was 20, 30 years ago to now where it is consolidating, and one side needs the other more than the other, basically. So effectively where funds, I think IFAs were effectively frowned upon, being the poor relation, as it were, and didn't control the assets. Now they control the assets, and in actual fact, the old stockbrokers and wealth managers are merely the fund manager. And I think that dislocation over the last few years is now starting to take effect. And we see with our peer group that they've reached down into the IFA and wealth advice, as it were, business. And we realized that probably there are a lot of consolidators in the IFA space, and I mixed the two together, but the IFA space, there was lots of them, and still are lots of them. But the reality is that controlling the assets and providing service, a good service proposition that is clean and that is differentiated, but owning the actual whole vertical, so that it goes everywhere from doing the custody of the assets and the trading through to the, call it fund management, investment management, through to the advice. There are three different components. And in actual fact, what Titan set out to do was to own that whole vertical. And that's really where we started.
Because I guess the regulatory environment is changing. There's more transparency on fees. There's pressure to have good technology, isn't there? And this just requires a larger scale, isn't it? A subscale IFA.
Yep.
Which was previously viable, actually.
Yeah, it's very difficult.
Yeah.
And I think, when I started in 2000 with Pantheon, I mean, we did 8 acquisitions over 5 years. We got up to about 1.5 billion of assets. It was relatively easy then. It was different. It was massively compliant, but now what you need risk. You randomly put stuff in investments that were, the rise of the collective unit trusts, whereas if people used to use stockbrokers all the time to go and have investment management, rise of ETFs and passives over the period of time, unit trusts becoming different style of funds with profits. I mean, people remember with profits. I mean, it's gone away now because of low interest rates. And what I think has happened is that we realized early doors when we were setting out to do this was that to be the differentiator, we had to own the stack. So the fees effectively that ultimately a client ultimately pays. And we needed to consolidate those as the pricing comes down, because otherwise you end up in a race to the bottom, and there's only so far that you can go. If you're BlackRock or Fidelity or someone like that, you can keep, or Vanguard for argument's sake, you can keep compressing. And that, for what I would say, everyday IFA or even wealth managers, is a real problem. And so, as I say, our peer group, and I would say in sort of managers, wealth managers owning or having assets of 30, 40 billion plus, okay, you can play. But now your reg cost goes up. Now your tech cost goes up. You've mentioned that. Platform. There are so many platforms. There needs to be a simplification in that area as well, and bring into a common standard. And I think ultimately that will start to evolve, as well as consolidation of platforms. And the reason is because of AI. I think technology will start to take over. And I think you've got the legacy of insurance companies becoming administrators, whereas if they were investment managers, they're administrators. And these platforms can garner huge amounts of assets. But again, it's a race to the bottom in terms of pricing.
Is the consumer also changing, do you think? I mean, the technology equips people with a lot more knowledge. There's a lot more sensitivity on fees, isn't there? People feel they shouldn't pay for quite a lot of things.
Absolutely.
How do you see the consumer evolving?
It's a very interesting question. Everyone always pays. It doesn't matter whether you're up here or down here, you will always pay in one format or other. Because otherwise the industry and the finance industry can never work. How does the technology delivery? The technology delivery allows you to get what I would call bland product into the market at a very cheap price. You had Ian on earlier and talking about his stock selection and how he does things. That is actually probably the way funds should be run and investments should be run, because he has a theory and a process to deliver returns that aren't related to markets, market sentiment in some ways. He's actually just got a very clean process. The problem that I think the consumer has is they are bamboozled a lot of the time, and they don't understand. And I think that this is the sort of difference between advice, it is the difference between delivery of product and how clear that is. If you go through a platform distribution and B2C type model, the regulator is there giving you risk warnings on absolutely everything. The problem with the product for B2C is that it becomes bland. It becomes, it has to be to the lowest common denominator. Yet the reality is that if we want to try and distribute product into the market, which I would say is above average quality and is trying to actually deliver returns to an investor in a sort of democratized way, and this is about democratizing product, you have to have something that is a simple process. And I would argue that although Ian deals with high net worth individuals, and largely, and fine, he has a fund as well, but he deals with high net worth individuals who in theory understand the risk, I would argue that there is less risk for what he's doing relative to what other product in the market is. So we are in a bit of a dichotomy, and you have to then work out how are we going to deliver this. Platforms, in our platform, we effectively deliver or have access to product like in providing a fund structure. I think from a risk rating perspective, it is able to be put into all the usual funds from MPS through to have it holding it directly. And how this affects the consumer is that if you have £100,000, you can still access the same thing. You're getting exactly the same thing or product. As a guy who is having a bespoke portfolio, it might be tinkered with on one hand or other, but you're getting access to the same process. That's probably a better description. With a discretionary, I mean, I would argue that the world is controlled by institutions from the point of view of investing. And so it doesn't matter whether you have £1 million, £100 million, or £100,000 with what we are providing, which is good quality of advice, but it tied in with good fund management and asset management, that all of those parties are able to access that. what we're trying to deliver is product that is a stockbroker. If I go back 30 years ago when I started, it was only the rich who were able to get hold of it. Basically, if you had I don't know, £1 million portfolio, you went to your stockbroker. You didn't go anywhere else. And from an advice and IFA and the Titan group, so we have advice through to the discretionary fund management, through to obviously the custody and assets and the trading, you're able to access this at all the different levels, whether it be in a fund or discretionary. And I think the consumer will pay what is relevant to where they are in that process.
And what are the pillars of the proposition? I mean, you touched on there some of the areas. Perhaps you could just unpack that.
Okay, yeah. This is quite an interesting one. Okay, so if you go back to how we were created, or what we wanted to do was a vertical stack. In actual fact, what we're actually looking at is we have the utility side of the business, which is trade, custody, clearing and platform. That can operate for us and it can operate for third parties. It does operate for third parties. You have the investment management business, and the investment management business then ultimately has 4 pillars underneath that. And I'll come back to that in 2 seconds. And then on the third pillar, you have advice. You have a financial advice. We have a restricted proposition and we have an independent proposition. We actually more recently have added to that is that we have an external research arm called Square Mile, which we bought last year, and I think it completed early this year. And that is to provide independent MPS and research to institutions and about 75 IFAs as well, independent groups. So we utilised some of that in conjunction with Ian and various other parties within the business. Asset management, 4 pillars. So if you look at the IFA world, it's been a race to the bottom, as I've said, with using passives, etc. Great, they fit a bill. But in my opinion, IFAs should not be investment advisors. They should do financial planning and leave the investment advice to the professionals. We have all that. We have funds, we have our own ETFs, etc., etc. OICs, fund of funds. We have that. We've created our own structures. We're in the process of creating more structures. Ian's has a fund, a Titan Equity Growth Fund, which has been created under that. We then have direct equity, so we have access to that. Now, historically, IFAs have never or very rarely touched that. And I think that is the largest change, because where on passive and fund of funds and OICs and all the rest of it, you've had this sort of blanding through diversification. And people might hate me for saying this, and what do I know about investment? Very good point. But it is probably true, because they've gone to the mean. And I think that is...
You want a bit more conviction.
We want a bit more conviction.
Yeah.
And I think having direct equities... I mean, I've come from a stockbroking background, where I won't say I knew anything particularly then, to a IFA, fund of funds, OICs, individuals, ETF, passive, etc., world. And I'm actually mentally myself going back to a conviction style, good process, etc., fundamentals approach. And I think that that is a massive, massive game changer for both Titan, but I also think it is for the investment world, whether it be at what I call the retail level and at the high net worth. Because I actually think how you put that out into the market is, those are critical points. And then last but not least, and I think we are seeing it undoubtedly, is the rise of the alternative. An alternative is such a wide plethora of different, it could be long, short equity, global, macro, convertible arb, or it could be private debt, private equity, and anything in between. And I think that is where almost defined returns come. And if you follow probably where I'm going with that, defined returns probably are a very interesting way to look at what do most clients ultimately want. They want stable returns over a long period of time, and volatility needs to be knocked away.
Well, particularly for smaller investors who want a bit more certainty, but traditionally they've been excluded, I guess, from the alternative scene.
Absolutely. And I think we will be a major player in certainly internally within our our business. I mean, we currently have about 17 billion of assets. We will probably be on our acquisition trail. It takes us to about 35 billion by June. We will see reasonable allocations start going down this route, more because of stability of return. And it would be logical, wherein our advice business, that 60 to 70% is pension orientated, whether it be pre-drawdown or post-drawdown, stability is key. And I think that we are able to provide that. We're in the process of just creating our own long-term asset fund. That hopefully will be live in about 6 months' time. But we've been through all the pre-process. And we are joining the likes of Schroders and I think Octopus, Fulcrum, who've got one. Elgin announced yesterday exactly the same thing. And we think there is an opportunity to provide our clients within Titan, which is a lot of them, with access to product like that.
Well, and the breadth of the proposition also allows a lot of different styles of intermediaries to interact with you. Just thinking about, say, the trustee fiduciary market on the custody piece even, and I guess across the wealth spectrum from the family office down to the retail investor. How do you see kind of the different segments of the spectrum?
I'm a very much sort of try and keep it as simple as possible. I think the proposition, we're in danger as a business of having too many propositions, because you buy now strategically. We've been buying. We buy for cash flow. We are effectively a cash flow investor into the proposition. We're a long-term holder. We're very well. Our balance sheet is strong. We have a lot of equity behind us and what we're doing. We're trying to grow, but we're growing very strategically. We're not just buying up everything. So we're buying, obviously, into the distribution space, which is advice. Product provision, less so, because I think we've got all the brains and brawn within our existing book already. And our utility side of the business, there are bits that probably can be added to. We need to keep a very straightforward proposition. And I think, why is that? Because at the end of the day, I go back to risk, volatility, distribution, all these points. And if we keep it concise, we will grow naturally and appeal to the institutions. We have 200 institutions who already deal with us on our custody and clearing. So we already have that. We have 20 on our platform already, independent to us. So we don't own them, nothing at all. We then go into external or fund management. We have external people who use our funds. We obviously utilize them internally. And then from an advice point of view, yes, admittedly, actually we provide services to other IFA groups through both the funds, but also through the platform and through some of our services that we utilize internally. So we're trying to cover all bases, but we're trying not to be overextend and keep the proposition simple.
Got it. You're a UK-based group, but looking at overseas markets as well. I mean, how do you see markets outside the UK in the wealth space?
So, if you want me to be brutal, I think overseas has generally been deemed as quite Wild Westish. I would argue that the regulators out of the Far East, Middle East are starting to tighten their grip. I think there have been some notable issues that have been brought to the forefront over the last 5 years. We see that the market is professionalizing massively. We are already in negotiations on various offshore, and I'm actually going to call them international rather than offshore. And I think that we think the growth for that market, we are predominantly UK, and we're set up to be predominantly UK. But there are businesses offshore, internationally, that would be relevant for our growth, partly through the distribution, partly through providing product, good quality product and wholesome product to that market. And I'm not saying it hasn't been there before, but I think the opportunity set is, there are a lot of emigres from the UK. The UK is respected as a regulator. Singapore is I've just come back from Singapore, funnily enough. It's a fascinating space. Ironically, it's local market rather than expat, interestingly. And there are things happening out there. There are quite sort of big plays out there, titanic plays and titanic shifts in what's going on. The Middle East as well. It's historically been very Wild West. The amount of inflow of money into that area has been high. I find not necessarily from British expats, but that is now happening. The spending power that Saudi brings with their rise of NEOM and various other projects that they've got going. It's fascinating. So why shouldn't we look to provide a provision of service where we can give them exactly what they want? We then can look after expats when they come back to the UK, and we have that provision. And we have actually a tax service that we can operate on that basis as well.
James, terrific to talk to you today, and we look forward to sharing this interview.
Fantastic. Thank you very much.